Okay, so today we are looking at financial accounting. There are some of the basics that we need to understand when it comes to financial accounting. But before we start looking at those basics, uh, we need to understand what is financial accounting. So it is very important for us to know what financial accounting is. Then from there, we will look at some of the most important basics that we need to understand. So for now, we need to define what is financial accounting. What is financial accounting? Okay, so financial accounting, this is the process of recording, identifying, summarizing, and reporting every business transactions. So this is the simplest way you can define financial accounting. So it is the process of recording, identifying, summarizing, and recording every business transactions. So just from the term itself, process, meaning it has got some stages, it has got some procedures to follow as we are recording these transactions. So what is the whole essence of doing this? So the primary goal is to expose a company's profits and the losses. So financial accounting delivers a realistic and fair assessment of a company. As a result, it protects the interest of stakeholders. So in business, whatever transaction you make, either buying, selling, you need to record. As long as revenue or money is involved, you need to record. So whatever you are buying, on the date that you make that purchase, you need to record. Whatever you are selling, the day you sold it, you need to record. So after recording, the time will come now for you to make those, to start now identifying those transactions. You identify those transactions, you group them, then you start now summarizing. After summarizing, the time will come for you to make the report. So it's only by so doing that when that's when you can tell to say your company is making profits or losses. Minus recording, you can't tell whether your company is making profits or losses. But if you buy something, you know how much you have spent. Then after selling that particular, or after selling those items, you generate money into the business, and you know now how much money you're supposed to earn, or how much money you have earned for the things that you bought for resale into your business. So in the case you find that you have generated much money than you spent, meaning you are making profit. If you generate much money, if you earn much money than you spent on those particular items, meaning you are making profit. But if you find that have made, let's say you have earned less money than you spent, meaning you spent more on those products, and finally find that you have earned less, meaning you are running a loss in that particular business of yours. So you can only tell either the company or either the company or an entity or that business of yours, if it is making loss, you can only tell unless you are doing all these processes. You are coding, you are identifying, you are summarizing, and making some reports. From there, the reports will show to say, okay, this is what happened in this year, this is what happened in this month, this is what happened in this week, and this is the money we generated after doing all these transactions. So you tell how much money you spent and how much money you earned into that particular business of yours. So this is the simplest way of defining financial accounting. It is the process of recording, identifying, summarizing, and reporting every business transactions. So that is the simplest way you can define financial accounting. Now let's look at the basics. Okay, so the whole process of recording transactions of the business is what is called bookkeeping. Bookkeeping, in other term, we can just say recording, is same as recording. So as long as we are tracking down the records of whatever transaction you make in that particular business, that is what is referred to bookkeeping. You are keeping the records. You are writing down every transaction in chronological order. What you sell today, that must be recorded today. What you sell tomorrow, what you buy tomorrow, will be recorded on the same day, which is tomorrow. What you sold yesterday, what you bought yesterday, supposed to be recorded on the same day. So that process of recording transactions is what is known as bookkeeping. So we'll define bookkeeping, and if at all there is something else that we need to know, that are involved in bookkeeping, we need to know. We'll look at them as we're going forward, looking at the basics of financial accounting. The very most important basic that we need to understand under financial accounting. So what is bookkeeping? What is bookkeeping? What is bookkeeping? As I said, it is same as recording. So now recording involves what? You record every business transaction in order, in chronological order, in organized accounts. Okay, so let's now look at what it is in financial terms. How can we define bookkeeping and what does it involve? So without wasting much of our time, let's look at it. Okay, so what is bookkeeping? Bookkeeping is the daily recording of your company's financial transactions. Daily recording of your company's financial transactions into chronological order or into organized account. It can also refer to the various recording techniques available to the business. It can also refer to the various recording techniques available to business. Okay, so bookkeeping is nothing rather than a recording. Okay, as I said earlier on, it's just the recording but recording what? Business, financial transactions. You are recording financial transactions. So that is all about bookkeeping. You are recording the daily, doing daily recording of financial transaction into organized accounts. Okay, so that's all about bookkeeping. So now the question is, how do we record these transactions? How do we record these transactions? And that's what I want you to know. And these are the only basics that now the only basic that I'm talking about. So let's look at how we record these financial transactions now. Okay, so this is how we record financial transactions from the initial stage up to the last stage. So let me just try to do a rough diagram here, because I'm using a mouse, so you just pardon me with my drawings. What is important is getting what I'm doing. So I want to draw a diagram showing the stages. Okay, so there is the initial stage, then there is second stage, something like that, then there is third stage, and finally the last one. Okay, so these are stages. Never mind about the drawings. Okay, so the first stage is called journal accounts. So journal, this is A. So Jour. Let me just write it properly. So journal. Then URNA. Wow. Okay. Okay. So that is N, then AL. So journal. The second is called ledger. So that is LEDGER. Then the third stage is called trial balance. Okay, so that is TRIAL. Then we put the balance there. Wow, N has been extended. This looks like a bench. So that is NCE. Never mind about the writings. Then here there is what we call financial statements now. So the last stage is financial statement. Oh, hey, can write flames. So financial statements. Okay. Financial statement. This is a statement. Okay, let me just write proper. Never. Oh, shit. Okay. All right. Okay. Sorry. Pardon my manners. Okay. So statements. This is E. So that is statements E. then S crust. Okay, so this is now the order we follow when recording transactions, financial transactions. The first stage, the first account where you record the transaction at the very beginning of the transaction. The initial stage is called journal. So journal accounts are not even supposed to be balanced because in financial accounting there is what we call single entry system and the double entry system. So now talking about the single entry system, it occurs on this same stage where we record the transaction just in how you record it today, tomorrow, what and what. So the entries in this are all single entry system happens on this stage, and the accounts are not supposed to be balanced because it is a single entry. So on a daily basis you'll be having different balances when it comes to money will be going out, money will be coming in, money will be going out, money will be coming in. So you'll be recording a transaction one by one. So the balance, there's nothing like balance in the balance here because it is a single entry. Then the second stage, it is called the ledger. So ledger accounts. So now this is where double entry system occurs. This is where double entry system occurs, and the balance here is supposed to balance. The balance of this account, all ledger accounts must be balanced. Then after recording journal accounts, you create ledger accounts. After creating ledger accounts, now you extract trial balance from ledger accounts. So after doing ledger accounts, the third stage is to extract trial balance. You extract trial balance, and here the balances here and here have to balance. If it is there is 5,000 kwacha into the let's say on the credit side, even on the debit side must show 5,000 kwacha when closing at the end of the account. Then you'll be getting these accounts from ledger to extract a trial balance. A trial balance, it has two balance columns actually. It has got a debit balance and a credit balance. So when extracting it, you have to make sure that the balance on the credit side and the balance on the debit side are all equal. Then from there we'll get the same entries of the same trial balance to create financial statements. Now there are a lot of financial statements, about 4. So there are about 4 financial statements. Okay, 4 financial statements. Okay, so there is CF representing cash flow. There is BS representing the balance sheet. Then there is IC, let's say IS, income statement. Then there is what we call statement of retained earnings. So statement of retained earnings. These are the initials. I don't know if you have ever seen something like this, but this is what I can do. So CF, this is cash flow statement. BS, this is the balance sheet or statement of financial position. IS, this is income statement or statement of profit and loss. Okay, then there is this statement of retained earnings. So you can only prepare these four statements, and this is where reports occur. What do you want to prepare after tracking all this record? At the end of the day, at the end of the year, do you want to prepare a balance sheet? You get, because all these trade records has been already tracked. So from the trial balance, you are able to create financial statement. From the same trial balance, you are able to create income statement. From the same trial balance, you are able to create cash flow statement and statement of retained earnings. These are the reports we are talking about. So here you record, you identify, you summarize, and the last you make a report. So the essence of doing all this record from first to third is creating these statements, because statements are the ones that are going to tell you whether you're making loss or profit. They're the ones that are going to show you how your business, how the money was coming to the business using cash flow statement, and how the money was going out of the business. Balance sheet shows the asset of the company as well as the liability of the company. So if you want to know whether the balance or either the asset of the company is much more than the liabilities, you use balance sheet. Income statement. Income statement shows profit and loss. This one will give you a negative balance if you are running a loss at the end. As a net profit, it will be negative if you are running a loss. But if you are making a profit, the net profit at the end, it will have a positive sign. And this one is specifically for the shareholders statement of retained earnings. So we'll be looking at this one by one, but for now, let's look at journal entries up to financial statement. But we'll go in details and we'll show you how to do all these, how to extract these financial statements. But what I want you to understand for now is how to record entries at initial stage, ledger, how to do ledger accounts, how to extract a trial balance. Then from there, finally, I'll look at how to create financial statement from the same records in the trial balance. So we'll define what journal is, ledger, and trial balance, and financial statement, and that will be the lesson one for this. And the next time when we meet, we'll look at now how to do now the entries. We'll do some calculations. So for now, let's define what journal is. Okay. So before we define what journal accounts are, we need to understand these are the documents used to record entries. So as I explained previously, the first records entered into journal accounts, the initial stage of financial transactions are recorded into journal accounts. Then from there they prepare ledger accounts, then they extract trial balance. After extracting trial balance, you are now capable of preparing financial statements from the same previous diagram I drew. So these are the only documents involved in tracking down the records of financial transactions. So now we'll define journal accounts, ledger account, trial balance, and the financial statements. Okay, so let's look at them. Journal. What are journal accounts? What is journal? What do you understand by the term journal? So this is an accounting book in which transactions are documented in chronological order. Then I write this part so that we get to understand it better. Okay, so this is an accounting book in which transactions are documented in chronological sequence or order. It does not have to be balanced. Like I said earlier, the records in a journal account have nothing to do with balancing the balance at the end of the day. No. Because I said that's where a single entry system happens. How can you balance a single entry unless if you are doing double entry? Okay, so according to Donald, he defined journal as a journal in accounting is a chronological record of all financial transactions of a company entity. The journal is used to record the debit and credit connected with each transaction and act as the first stage in the accounting cycle. The journal entries are subsequently moved to the general ledger, which is a comprehensive record of all accounts kept by a business. Okay, and this is something that we talked about. Okay, so the journal is a book or electronic record where all financial transactions are initially recorded in chronological order, serving as the basis for further accounting process and financial reporting. Okay, so as I said, so journal, for example, what can I give? The best example I can give, maybe I can talk about the receipts. You go into a shop, right, to buy something, they give you a receipt. They use machines to generate that receipt. So with this modern world now, where there is so many advanced technologies, there's nothing like getting a book recording. Others are still doing that, but with big businesses, they are doing that electronically. So the same machine is able to keep the information of every transactions we're doing. So it will be very easy for the management now to generate the information whenever they need it to prepare other documents. Okay, so for now, let's look at ledger. We need to understand what are ledger accounts. Okay, ledger. This is the final entry book in which transactions are split and entered in distinct accounts. It needs to be balanced. Okay, needs to be balanced. As I said, it needs to be balanced. So, this is the final entry book in which transactions are split and entered into distinct book. So if you follow the statement I gave when I was defining financial accounting, I said it's a process of recording. So recording, you record, that is put now the initial stage, writing that transaction into ledger account. Then you identify now doing ledger accounts. That's where you write now the accounts, you record into different accounts and you balance it up, you close. Then when summarizing now, you just put in a trial balance. After doing a trial balance, you are now capable of preparing the reports, which are financial statements. So this is the final entry book in which transactions are split and entered into distinct accounts. It needs to be balanced, yes, because this is where double entry system occurs. So all ledger accounts must have equal balance at the end of the day. So a ledger account is an essential component of a double entry bookkeeping system in accounting. As I said earlier on, it is a detailed record or repository of financial transactions for a certain category or component of a company's financial activities. Okay. Then a chart of accounts, okay, which categorize different sorts of transactions: assets, liabilities, equity, income, and expenses. It is often used to manage ledger accounts. Okay, each ledger account represents a distinct financial aspect, such as cash, accounts receivables, accounts payables, inventory, sales, wages, and so on. So just like I said, so this is where now some identification happens. This transaction is foreign. If the transaction is foreign into account receivables, where you have got some people who are owing that business money, so you need to identify to say this money is coming into receivables. If it is you who is supposed to pay your suppliers for the things you got in, maybe on credit, you identify that transaction to be accounts payable, to be into accounts payable. Then inventory, then sales, wages, and so on, because there are so many accounts. So this is all about ledger accounts. This is where identification happens. You identify the transaction to say it is falling into accounts payable or into accounts receivable, or this is an inventory or asset in short, or this is sales or wages. Okay, so we have talked about John being the record, then ledger being the identification. So this is where identification happens. So let's look at trial balance now. Okay, what is a trial balance? So trial balance, this is a spreadsheet for bookkeeping that shows the credit, and the debit balances. As I said, the trial balance has got two balance columns. So it shows the credit and the debit balances of the ledger accounts, because we use ledger accounts to extract trial balance. Okay. The trial balance is significant because it preserves the arithmetic precision of transactions. Okay. So you use ledger accounts to create trial balance, and the trial balance has got credit and debit balance columns, and it has to balance. Whatever balance will be on the credit side must be equal to the balance on the debit side. So the trial balance is a basic financial report used in accounting to confirm that the bookkeeping records are accurate. The bookkeeping records are accurate. So let me highlight this. Let me highlight this accurate term. Okay. So Trial balance is what will tell you to say all the entries in two ledger accounts are correct once it is balances. Okay, so it describes the ledger account balances at a certain period in time. Typically, the trial balance is created at the conclusion of an accounting period, such as month, quarterly, or year. So, when do businesses, owners, or management prepare trial balance? So, it can be a month, or half a year, or maybe, quarterly, or after 3 months, or year. So, trial balance can be extracted at the end of the month, or at the end of 3 months, quarterly, or at the end of the year, which is 31st December. Okay, it depends with the agreement the management agreed to. So be preparing if it is yearly, quarterly, or monthly. Okay, so that depends with the policy of the company. So the fundamental goal of a trial balance is to ensure that the total debits and the total credits in the ledger accounts are equal. It aids in the detection of inaccuracies in transaction recording, such as errors in posting amounts or entering debts and credit on the incorrect side of an account. Okay, so sometimes you can make a mistake when recording a transaction, or maybe you don't know where that transaction is foreign on. Maybe you just mumbo jumbo that particular transaction supposed to be on the credit side, then you accidentally happen to put it on the debit side, meaning the trial balance won't balance not until you are able to enter the correct entries. The one that's supposed to be on the credit, they have to be on the credit side. The one that's supposed to be on the debit, they have to be on the debit side. And after that, the trial balance will balance and everything will be smooth. Okay, now let's look at financial statements. What are financial statements? These are a collection of summary levels reports. Let me highlight this. These are a collection of summary level reports that show the organization's financial results, position, and cash flows. Okay, these are the things that I talked about earlier on. So, financial statement, after preparing the trial balance, if you want to see how money comes into the business and how money goes out of the business, you prepare cash flow statement. It will be the same report which will show you. In account, there is nothing like explaining things orally. No, I bought this, I did this, the change I used this to buy fuel, nothing like that. No oral communication when it comes to financial accounting. Everything must be recorded, and all the conversation will be based on what is recorded. So, yeah, after doing that, you show the report. If you want to prepare cash flow statement, you give out the report. The management and the user will sit down and check how money comes and go out of the business. Then financial statements are formal reports that summarizes a company's financial activities and results over a given time period. Okay, they are critical for both internal and external stakeholders to analyze a company's financial health, profitability, and viability the balance sheet, income statement, cash flow statement, and the statement of retained earnings are the four primary financial statements, and these are the things that I talked about earlier on. So, a user of financial statement can be external or internal. Now here they're talking about the internal and the external stakeholders. Okay, so let's say you want to get something on credit from a certain supplier as a business. So that particular supplier will ask you to provide a certain financial statement. Or maybe you want to get a loan from a certain bank as a business. They will also tell you to prepare a statement. It can be a balance sheet, cash flow, because they want to assess to say if we give this particular business these goods on credit, are they able to give us our money within a year? In less than a year, they get that particular balance sheet, or I don't know if it is cash flow statement. Then they start now looking how you do your trade. They will look at your assets, they will look at the liabilities that you have, and if they find that the liabilities are much more than the assets owned by the company, meaning they can't give you that money unless they find that the assets are more than the liabilities. Then you can be one of the lucky people to be given that amount of money. So these are the reports that a company and every business are supposed to prepare. So yeah, let's now summarize this. So as I said earlier on, you record a transaction. First, journal. You enter that transaction into journal books. Then after that, you prepare ledger accounts where you start now grouping those transactions. The one that are supposed to be on the purchase account or purchase account receivable, it goes the creditors, the same. Then after that, you balance up, you close the ledger account, then you extract trial balance based on the information from ledger accounts. The same accounts here, they are the ones that you use to create or extract trial balance. When you extract trial balance, you can use now the entries of trial balance or the particulars of trial balance to prepare financial statements. Whatever financial statements you need to prepare can come from trial balance. If it is cash flow statements, this one here, you get the details or the transaction to prepare this from the trial balance. If it is balance sheet, the same. If it is income statement, the same. If it is a statement of retained earnings, the same. So these are the basics, one of the basics I wanted you to understand when it comes to financial accounts. And so when we come next time, this will be the first lesson. The second lesson, I'll show you how to record journal entries. If there will be enough time, we'll do 2 journal entries where a single entry system happens, and ledger accounts where double entry system happens. I'll show you how you can identify the transactions and do the simple calculations. So for today, we'll end here. Thank you so much.